Our global economy has changed drastically in the last 12 months because in 2021 we kept hearing about how the global economy is so strong and how robust it is, and now those exact same people are essentially saying that a global recession is guaranteed if we're not already in one right now. The main factors that are contributing to this global economic slowdown are, for one, the war, second, you have energy prices, you have a food shortage, and not to mention inflation. All these different factors coming together are impacting countries in Europe. It's impacting countries in Asia. It's impacting us here in the United States, where the economy is slowing, but still nobody wants to admit that we're entering a recession. Let me actually read you this one sentence from a Bloomberg Instagram post that's titled, "The European way of life isn't looking too sweet." And what it says is that a multi-year shock to living standards looms large across countries such as Spain, Italy, France, and especially Germany, as real wages fall faster than their counterparts in the United States, where life will look sweeter. Europeans will have to contend with less energy, less output, less disposable income, more inflation, and higher import costs. Social unrest is a real risk. That's a not so pretty picture for a number of different European countries that are saying that what we're having here in the United States looks very sweet compared to what's happening in those countries, but if you dissect what's happening in the American economy, that doesn't look very sweet either, which gets you more concerned about what's happening in the global economy. But there's a few factors that I want to focus on today. I want to start by talking about the UK economic slowdown and how this will directly impact us here in the United States. Second, I want to talk about the Chinese economic slowdown. And third, I want to talk about the dollar and this global currency crisis that we have going on right now. First, let me talk about the UK. So the British economy was facing some of the highest inflation that they have seen in decades, kind of like what we saw happen here in the United States. And people were moving away from the pound, which is their currency, into other currencies like the dollar. That's why we saw the pound lose value relative to the dollar. We had these big investment institutions in the UK, like pension funds, that were investing into things like their own government bonds. And so they would invest their money into these government bonds and then get interest on these government bonds, which then they would then pay out to their pension holders. Now, if you invest your money into a pension, you are looking for a consistent stream of income when you start receiving your pension. And the way that the pension funds would give out these pensions, they would invest their money into these government bonds, which are very safe, which paid good interest rates, and then you never really had to worry about it because the pension funds always paid. Well, in 2020, when the pandemic hit, the Bank of England, their central bank, kind of like the Federal Reserve Bank, cut interest rates to near zero. And so when they cut interest rates, the interest rates that pension funds started to get also dropped. This didn't just happen in 2020, this has been happening for a number of years, but the interest rates now that pension funds were getting was dropping, so they were struggling to continue to pay their pension payments. So what did the pension funds do? Well, they used this opportunity of low interest rates to go out and borrow money to buy more government bonds. That way now you can borrow money cheap and buy more government bonds that are paying interest, kind of like arbitrage. That way now you have more money coming in to pay off your pension holders. And this is what's been happening in places like Britain. We have the same thing happening here in the United States. But what happened in the UK then was the pound started to fall and the bonds started to drop. They had a new prime minister come in who changed their policies. People got worried about more inflation coming to the UK, so they started selling off their bonds. Bond prices started to collapse. And now you had these huge pension funds, these huge investment firms that not only own a ton of bonds, but are completely leveraged up to buy more bonds, which were supposed to be the safest investment in the world. That way they can continue making their pension payments. People's retirements are hanging on the threads of these pension funds. And now these pension funds are getting hit with margin calls, collateral calls, saying that your debt, your payments are due because your investment is falling. The underlying value of your asset is falling, so you need to make a payment. Now these pension funds and investment funds said, we don't have all the cash to make these margin calls. And if they don't make the margin calls, then they go bust. They lose everything. So they started to sell even more of their bonds now to have cash. So they're liquidating their investments to have cash to make their margin call payments, all while they're risking the citizens' retirement accounts, the citizens' investment accounts. And this is where you started to see an even bigger drop in bond prices, into the pound prices. And that was where just recently you saw the Bank of England open up their money printer and say that they would now bail out the bond market. And they started printing more pounds, printing more currency in order to buy more pounds, in order to save their currency, in order to save their bond market, in order to save the pension funds, which they did. Now the pension funds saw their bond prices rise and they were okay. They didn't have to worry about their margin calls, but you were fueling one bigger bubble. Because now when you print more money, that creates more inflation at a time where inflation is already near record highs. So you got to understand the dynamics of what's happening, because now the UK economy is really struggling. Because now not only do you have this bond market collapse happen, you have the whole economy that's starting to struggle more. You have all the inflation issues, and it doesn't look like it's going to go away, because the central bank doesn't want to see the pain that would come from these types of failures. And it only took one thing to cause the entire bond market to essentially almost collapse. Now you have to think, what if something like that happened here in the United States? Because we have similar issues. We have pension funds and institutions that are leveraged up to their eyeballs, that are relying on things like government debts in order to survive. If we were to see something similar happen here, what would the Federal Reserve Bank do? Would they bail out the markets and cause more inflation? Or would they let them fail? Now, letting them fail has consequences. People lose money, investment firms lose money, people lose their jobs. However, if you don't let them fail, you cause more inflation. You build a bigger bubble. It causes more problems, which means that eventually, when the bubble ultimately has to bust, because you can't just inflate the bubble up forever, when the currency ultimately no longer has value, that pain then will be even more painful. And this is where the Federal Reserve Bank has to make that distinction, and we have to see what will happen, because it only takes one thing to trigger the dominoes to fall, especially when you've been in this low interest rate environment for so long, like we have been here in the United States. We've been in a near 0% interest rate environment since after the 2008 crash. So our economy has been super reliant on low mortgage rates, low interest rates, low cheap debt. And now for the first time in 2022, we are skyrocketing our interest rates at very fast rates. And now we have seen mortgage rates rise, we've seen interest rates rise, and now all these companies and institutions that have been relying on and banking on these super low interest rates are gonna see a shock when the effects of these higher interest rates trickle down the market. And if one thing starts to fall, it could trigger many more dominoes. And this is where the question is the Federal Reserve Bank going to let the economy correct, like they say they're going to do, or are they going to give in and produce more inflation, which will ultimately make the bubble bigger? And so this is why you have to pay attention to what's going on in the UK, because this could foreshadow what could happen in the United States, because it took one thing to trigger the whole bond market to collapse, essentially, until their Bank of England went in and bailed them out. But that's going to come with consequences as well. As we all know, inflation is a price that regular people have to pay. Now, we did cover this entire story in Market Briefs, which is my free financial newsletter. If you have not joined Market Briefs yet, and you are an investor, especially in this economic environment, you need to be aware of what's happening in the markets around you, and Market Briefs does that into a fun, easy to read and witty email that you can read in less than 5 minutes every morning. And the best part is that it's completely free. I created it as a resource to help you stay up to date on what's happening. That way you can make smart decisions with your money, and it's a really fun newsletter. I promise you, you're going to love reading Market Briefs every morning. So if you want to join Market Briefs for free, I'll put the link to how you can do it down in the description below. Second, let's talk about China, because what happened in China is very different than what happened in the UK, because in the Chinese market, people save their money not in stocks and CDs and savings accounts like you do here in the United States. People save their money in real estate, meaning people go out and actually buy homes with their extra cash. That is the way that most people save their money in the Chinese economy. So it's a little bit different. But they also build real estate very differently in China. The way that they build real estate in China is that you would go out and buy a property, but before you buy the property, the developer is going to ask for all the cash up front before they can actually build the property. So let's say you want to go buy a home for $100,000. A developer will show you the designs, and they're going to say, if you want to buy this home, we need $100,000 today before we start building. So you say, okay, I want to buy this home. It might take 6 months, 12 months, 18 months to build, but here is $100,000. So now you're going to go to the bank, get approved for a mortgage. You get $100,000 or $80,000, assuming you put $20,000 down. And then you borrow this cash, and then you give all $100,000 to the developer. That way now they have the money to start building the home. Now, so far, no big deal, right? Yeah, maybe you have to pay some mortgage payments before you have a home, but you're paying the developer. It's just the way that the system worked. But now developers started to take advantage of the system, because they said, why do I need to take this now $100,000 that you gave me and invest it into the property that you paid me for, when I could take this $100,000 as a developer and go out and start a second project? And that's what they were doing. They were taking the cash from project number 1, using it to start project number 2, Then they would sell project number 2 to a new buyer because people invest their money and save their money in real estate, so there will always be more buyers in the Chinese real estate market. And then they would take the profits from project number 2 and use that as the money to build project number 1. Now, if you're using the profits from project number 2 to build project number 1, how are you going to pay for project number 2? Well, you go out and build project number 3 and project number 4. And then you keep doing this on and on and on, where you keep building more and more projects, and the future projects are going to pay for the previous projects. Here's a very rough design of how it all worked. You put money down for this property, and the developer is going to take the money for this property and use it to start building these 2 properties that they're then going to put on sale. As soon as the developer sells these 2 properties, they're going to use some of that money to pay off this property, but then they're going to also need money to build these properties. So now they're going to build this, and this property. That way now they can work to sell these properties to pay off this property. And this went on for years and years and years. And then something happened. Buyers started to go away because prices of real estate kept going up. It became much more expensive to own a home, kind of like what we're seeing happen here in the United States. Home affordability started to fall, and populations in China started to fall, kind of as a side effect to their one-child rule that they had back in the day. And so now you have a smaller population for the first time really ever in China. And you have home prices and home affordability that is also very low. So buyers started to walk away. Now developers here were not able to sell their homes. And when they weren't able to sell their homes here, they weren't able to build these homes. And when they weren't able to build these homes, this eventually started to trigger them not being able to build these homes. But they've already sold these properties. People have already gone into debt and given them their down payments to buy these properties. But now their home is not being built. This created a whole lot of chaos in China because then people stopped paying their mortgages. Banks lent money to people, that way they could buy this home. But people have already borrowed the money, paid for the home, but are not getting a home. So they stopped paying the mortgages, which not only hurts the bank, it hurts other parts of the economy because now banks aren't getting paid and they don't have the money to pay their employees, and developers are going bust at the same time. And so you started to see a lot of civil unrest in China, where now people are walking away from their deals, they're not paying, they're rioting in the streets because they're paying their down payment, they're paying their life savings to buy these properties that they're not even getting. So now you had developers going bust, you have mortgage companies going bust, and that's when the government had to step in and they bailed out people like developers and mortgage companies to keep the system running. Now again, they have created more inflation to help save the economy in the short term, but there's going to be more consequences to that. And so you have a major economic crisis that's occurring right now in China. You have this major domino that's happened in the UK. We've already talked about all the other things that are happening in European countries, and the United States has been kind of like the safe haven. That's why people have been moving to the dollar, because everybody keeps saying how the United States is the place to save your money. It's the safe currency. Nothing's wrong in America. But here, we also have red flags happening. We have seen a lot of inflation happen here in the United States, which means that the value of our dollar goes down, causing us to use more dollars to buy things. However, when you compare the dollar to currencies around the world, our dollar has actually grown in strength, meaning that countries, other currencies, have lost their value more relative to the dollar. The reason why is because you have all these countries around the world that are looking at the dollar and the United States as the safe haven for their currency, their savings, and their money. Now that's good news for us temporarily, for most people, because now when you have a stronger dollar, if you were to go to Europe, if you were to go to Asia, you can buy more things with your dollar. It's good in that sense. It does make exporting things more expensive now, because if somebody wants to buy a product from the United States, they're going to need more of their cheaper currency to buy stuff from us, but we have more buying ability from other people. So in that sense, it's good. However, there's a big concern and a risk there, because what happens if people start to lose trust in the dollar? What if something happened in the American economy or to our currency to cause people to lose trust in their dollar? Like, say for example, the United States economy continued to slow and inflation continued to stay high. If inflation continues to stay high and the economy starts to slow and we were to enter a bad recession, then people might say, oh no, the dollar isn't a safe currency either. We need something different. We need to spend our money somewhere else, that way we can protect our currency. If people were to do that, and by people I mean countries, well, that could cause a dumping of our dollar. That could cause a dumping of our government bonds. If that were to happen, then you could see something like what happened in the UK happen here, with the entities that are very levered up to buy our own bonds to get interest from government treasury bonds, well, that could mean that they start to hurt. And that could cause a big bond crisis, a big credit crisis, a big currency crisis with the United States. And that could then trickle down into other asset classes. Like we have our real estate issue here in the United States, where real estate prices have ballooned over the last couple of years, while mortgage rates are also skyrocketing, which means you have home prices that went up to here, which were supported by interest rates down here. You can see my rough kind of a way of explaining. But now home prices are way up here and mortgage rates are way up here, making home affordability drop way down to here. And so it's very expensive for people to buy a home because you have all these factors coming together. And over the next couple of years, you're going to see all these things start to play together, because now we can't just run away from this issue. I've been talking about this for the last couple of years. The Federal Reserve Bank doesn't just have fairy dust that can make inflation go away. They're having to raise interest rates aggressively to make inflation go away, and they've already done that, but inflation has not gone away. And so if they continue to stay aggressive to make inflation go away, that's going to hurt our economy, that's going to hurt our real estate market, it's going to hurt our stock market, it's going to hurt the cryptocurrency market, it's going to hurt all assets, it's going to hurt businesses. This is why you want to be aware of what's happening, because we have all these things happening in different countries, and to think that it can't happen here in the United States is a very foolish way to think, because we are the strongest economy in the world. We have the strongest military. We have the best government in the world. However, we do have a lot of economic risks. It's the best place you want to be, but you have to be able to protect your money, because you have to understand that there's a lot of economic risks out there, and things happening in Europe, the things happening in Asia do impact us here in the United States, because there's less dollars in their countries, which will flow into our economy as well. They're buying less of our stuff, which hurts our economy. And that also means that now, if these things can happen there because of inflation and a slowing economy, those things can also happen here. And this is where you want to be aware of what's happening and not get blindsided by it. But you also want to understand that it creates opportunity for the people who are financially educated and prepared. That means looking for discounts of good assets that could come your way. And this is where you want to understand that the Fed does not have fairy dust to make inflation go away. High inflation hurts the value of our dollar. If our dollar continues to suffer high inflation, that could cause people dumping the dollar. If people dump the dollar, that could hurt our bond market, which would hurt a number of different investment institutions, which could then trickle down into many different parts of the economy. We saw that happen in the UK right now. If interest rates continue to go up to fight inflation, that could then hurt our real estate market. If our real estate market gets hurt very bad, well, that can then also trickle down to many different parts of the economy. So just understanding that fighting inflation is painful, but it's not as painful as not fighting inflation. Fighting inflation will cause a recession, it will cause asset prices to get hurt, but it's not as bad as seeing a currency crisis. And so understanding that this is painful, this is even more painful, but knowing now how do you position yourself to take advantage of the opportunities around you. Now this is where we are keeping you up to date on Market Briefs, my free financial newsletter. So if you haven't joined Market Briefs yet, make sure you do that. But this is where you want to be prepared and educated. That way you can take advantage of opportunities that come your way, instead of being the one that's blindsided and being one of those people that said nobody could have predicted it to happen, because the Federal Reserve Bank has already started to say things like nobody could have predicted an economic slowdown, nobody could have predicted high inflation. Don't be one of those people that keep saying nobody could have predicted this, because the reality is we're seeing it happen in other places around the world, and you want to be preparing yourself for whatever might happen. When people feel wealthier, they go out and spend more because they feel like they can afford more stuff. Even if they don't have the cash in the bank, they feel like they can spend more because they look at their portfolio and they see all that green and they're like, well, let me go spend. Then what about jobs? Because this one gets very tricky and very interesting, because the Fed has to word this in a way that's not going to incite